this is going to be a good one. This is our debt fireside chat with Brad Waite and Nate Lowy. So I'll let them introduce themselves a bit more, but this is a good trio right here. We've done, I don't know, I want to say a couple $100 million now in the last couple of years of origination and stuff. So these are in the trenches, experiences, war stories, and successes. So yeah, I'll just start off and let you go ahead and introduce yourself.
Sure. So Brad Waite, I work for the venture that is Cushman & Wakefield in Greystone on the lending side. I have been in multifamily finance for over 20 years, my only career, and the fact that Rob said this was going to be an interesting one is a good thing. In this market, I don't get that a lot, and I was happy to find out that we were doing this in the World Trade Center building, knowing how secure it was and being a debt guy doing a debt panel in this market. I would say my heavy focus has been on the agency side of the business, where I've partnered with Nate at Juniper.
Go ahead.
Nate Lowy, Juniper Capital Group. I've been doing debt origination for about 10 years. Started out in the ownership side, management operations, which led me into debt, and that kind of helped me understand what the owner side of the operations and how to get accretive debt for the ownership side. Like I said, I've been in the business for 10 years, done about 3 to 4 billion.
How do you do 3 to 4 billion?
It's tough to count.
Tough to count?
It's tough to
We
count.
round in billions.
Yeah.
10 million.
We can round up in 10 billions.
Right.
So I've done 10 billion. But
Right.
yeah.
So Nate, can you tell the story of how you guys got together?
Oh, that's a great story. It was about 5 years ago, right?
Mm-hmm.
Brad had been introduced to me, trading back and forth, and Brad happened to be in New York. He's like, hey, you know what? We haven't really connected. Let's sit down for dinner. And I figured, all right, free dinner. What can come of it? But I wasn't really too optimistic about it. We sat down, had a really great dinner. Very knowledgeable, very bright, really on top of his game. And at the end of the meeting, he looked at me and he said, hey, look, give me your smallest deal. Remember that?
Mm-hmm.
Give me your smallest deal, lowest risk one, and let's see what we could do. And Brad crushed it on the deal, and $2 billion later, here we are.
The best part was one of his partners, as we're leaving, says, oh, can you please bring me a menu? I'd like to order dinner from my family to go.
That is
I
a
said,
true
okay,
story.
that deal got a little bit bigger now to cover the cost of this dinner.
I can neither confirm nor deny the story,
Right.
but
That was a first for me.
yes.
But well worth my dinner
Yes,
and time,
yes.
that's for sure.
Best return on investment.
Exactly.
So before we talk about more specific stuff on the debt side, Brad, do you want to talk about macro stuff to set the stage? The multifamily business has evolved significantly in the last couple of years. So, what has happened and where are we today?
Sure. So I'm going to do the boring macro part that Rob mentioned in the first side. So interesting week for sure. Probably the most anticipated Fed meeting of the year, if not last year and a half on Wednesday. Feel very good, and the market is certainly indicating, Powell has indicated that there's going to be a rate cut. The question is 25 versus 50. I think that remains to be seen, but there's been enough signals where he will cut, and I think we'd all show up with pitchforks and torches if he doesn't at this point. But a little bit about kind of how we got here. Certainly, the run-up in inflation coming out of COVID, the supply stuff was real. The supply chain issues were real. Exacerbated and systemic, caused by probably the last decade of Fed policy, interest rates near zero, and then government spending. And on top of just the headline government spending that we see, the Fed all the while, especially during COVID, was buying U.S. Treasuries directly to keep rates down, was actually buying mortgage-backed securities on both the single-family and multifamily side directly, which was a first in our business. Loved it because it kept mortgage loan spreads low and kept the liquidity flowing. Full circle, we kind of are reaping some of what that is over the last year and a half from an inflation standpoint. I think that the two main components that the Fed has seemed keen to focus on are one, getting inflation to a target rate of 2%. Over the last 3 months, which we would call a trend, or Powell would call a trend at this point, we've held pretty steady in the 2 to 3% range. The second piece of that is jobs. Especially, we're still growing on the job front. The big revision, I think we got a lot of details out of an 800,000 plus job revision down. I think one of the most interesting pieces that was not widely talked about was the fact that over the last year, and I say the way they measured that would have been about June 23 to June 2024, we've actually lost as an economy over 1.5 million full-time jobs. So all of those jobs have been made up by part-time workers. So 100% plus of the job growth has been part-time workers. So that's been a little bit, certainly a shift in the paradigm of the economy over the last year and a half. I think that certainly reverses itself, but it's just kind of where we are now and leading into how the Fed is making their decision on when and why to cut rates now. So I think where we head, if I were betting, I would say 25 basis points. I think there's just nothing about Powell that tells me he's going to make a massive shock to the system, especially on this side of it. If I really knew the answer, I'd probably be sitting somewhere with a similar view and trading bonds for a living. But I think there's an importance here of adaptability from the standpoint of understanding where the job and rent growth is coming from. So, there is a massive shortage, especially with the number of part-time workers in the workforce housing space, right? And that is where most of the growth in this in-between cycle has come from. The Class A side has been a challenge, right? If nobody underwrote exit rate interest rates going from 2-3% to 6 to 7%, and a lot of the supply that was started that's delivering now is a genesis of coming out of a high rent growth period. The great news on that side is that is going to come to an end in the next 6 to 12 months. That there's units macro that have to get absorbed, and they will, because 26 through 28 are going to be hit at historically low levels. The same thing is true, just for a different driver, or the same model is going to happen from a pure population growth in the workforce housing space. We are adding a lot of population to this country in spots, and that population is going to have to be housed. Largely in workforce housing.
So Nate, do you want to take that macro and talk about agency, bridge, kind of where things are in the market today?
Yeah, so look, obviously rates kind of ran away from us over the last couple of years to fight inflation. But it seems like there's a light at the end of the tunnel in terms of rates coming down. All-in coupons now are trading in the agency side in the low 5s, high 4s. That's why some people pray to the agencies. But that's kind of been the agency world right now, kind of what, taking deals that are either purchases or that have high interest rates right now, either via rate cap escrows or bridge loans, and trying to kind of monetize the recent drop in rates.
And so one thing that's interesting about this market that's very different about the previous market, if you will, is the disparity in pricing between bridge and agency, right? Call it fixed or even floating, stabilized versus transitional. So how has that changed since before to after, and what's the outlook there?
Yeah, so interestingly enough, when COVID hit and we all saw tremendous rent growth, right? We saw 9% year over year growth. Everyone who was buying an asset wanted to unlock value. There was something to monetize there. So everyone ran to the bridge teams. As rent growth has subsided, call it more closer to 2 to 3%, a lot of value has been unlocked. And the demand on the borrower side hasn't been that great for bridge. But there still is a lot of product available for the right transitional play. It's no longer, hey, the market is going to go up, the rental rates are going to go up. let's just kind of bridge it, and so we're not locked into a loan. But now with, like I said, rents kind of subsiding, people are being more cautious with that, not really wanting to take floating rate risk at a higher rate, and opting more to fix. But there are still many circumstances where you're getting a good deal or there's really value to unlock, where a bridge makes sense, and there's plenty of powder for that.
Do you want to tell the Copperleaf story about how we did that?
Yeah, that was a great story. Put a deal under contract, ready to go for a Freddie deal, and then about 45 days before closing, Rob and Ken call me and say, hey, look, we may be able to unlock a tremendous amount of value with a tax abatement here, but we still can't push out our closing deadline. So made one phone call to Brad, said we need a quick 30-day bridge loan so that the borrower could refinance afterwards. I think it was through the Passover holiday, and we still pushed it through. Aggressive spread, aggressive terms, aggressive leverage, and now we're working on taking out that bridge loan.
Yeah, I mean, I think from the illustration from our perspective is one, on the bridge side, it's definitely taking more of a clear path to get there. It's not, in a market where interest rates are higher, rent growth is flatter, and it's not necessarily a decreasing or compressing cap rate environment, is illustrating to lenders the clear path that gets there. And we had done a number of these transactions on the perm side together. It was very much leaning in on your track record and saying, hey, we're all going to take this risk. Lone Star has done this. They have a process. They have a system. This is an extremely high likelihood of the right outcome. And that's what it takes. And it was relationships between the three of us and our capital partners that really made a transaction in this current environment, happen in 30 to 45 days. So we appreciate the partnership.
And usually, you can't have it all, right? If you want to close quickly, you're going to have to give up on terms. You have to go to a more like hard money shop type of deal. And so I think that's, for many circumstances, just untenable, and you're not willing to do that. And that's why a lot of these quick close deals just don't even happen. But when you do have an opportunity like this and can still get it done kind of through the more traditional means, is really where you can unlock a ton of value, which we're all working together on pulling off here.
And to your point, I mean, organization is key, right? I mean, there's no question that there are more forms to sign, there is more documentation to do in the current lending environment. So having that organizational, that infrastructure that you've created makes these types of transactions happen in addition to your track record.
So aside from our unique situation, which was a tax exemption, right, an affordable housing play, what are other use cases for bridge today? Because like Nate said, back in the day, a couple years ago, it was like, well, every deal went bridge because you're just going to get 10% rent growth, and the bridge was cheaper than fixed anyway, so just take it, take the extra leverage, take the cheaper money. But yeah, so Brad, how do you see bridge loans being used today and in the future?
So right, so that there's no shortage of capital by and large in the bridge space. I would say it's been a shift in where it's been deployed. Most of the bridge deals that we're seeing are in the Class A space. Deals that are built at a basis that can't be sold today and just need a little bit more time to season. There is still a challenge on the bridge space on some underlying assets that had operational issues to begin with, and really the last 2 years the economy didn't help that. I think the one thing we're going to see more of going into 2025 are agency floating rate loans. If you look at the Fed's own dot plot, even whether they cut 50 or 25 this week, they're still projecting 100 basis points of cuts by the end of this year. So that's a lot to happen. If you roll out a year from December of this year, it's 240 basis points. So that puts our floating rate index at 3%. Let's call it a plus or minus 200 spread. That's a 5% interest rate on an agency floater. So you're now at a leverage neutral standpoint, using it for one, unlocking the value. I think there's going to be, as we just discussed, a lot more upside coming in the real estate side, and then flexibility of prepayment. So I think we're a little bit on the earlier side of it from a perm standpoint, but I think this time next year we may be having a much more robust discussion about what an agency floating rate loan looks like.
Yeah, and the other thing, to your point, with rates coming down, if you buy an asset today on current values, which are lower than they were a year or two ago, good asset that you believe in the upside, you're not just gaining from the upside in the property. There's also interest rate upside, right? Rates go down, values go up, you could refi, cash out a little more. So, now, in my opinion, I think is a great time to buy.
But is it a great time to float?
Is it a great time to float? I think I said this last year. My interest rate crystal ball was broken. Has been for some time. But, if we trust the Fed dot plot, which take it for what you will, I guess it would be a good time to float. Presumably we're near the end of rates going up and hopefully coming down. But in my opinion, for the right asset, I think it makes sense to float.
And then there's also, like Brad alluded to, other considerations when it comes to fix and float, like prepayment penalties and flexibility there. What are other considerations or nuances on the agency side right now in being able to make sense of making the decision as far as spreads or underwriting criteria?
I think really you got to look at the business plan, right? A lot of what we're seeing is guys taking one of the deals we're working on, 7 years yield maintenance, and you pay a little bit extra in the spread to get only 5 years yield maintenance. It allows for more amortization on the back end for the lender to give you more IO, but also allows you to exit when you want to. And the interesting thing that we kind of been working on is that, especially with Freddie Mac, technically, generally, they're defeasance, but if you pay for the shorter yield lockout, it's yield maintenance, right, which is a cheaper prepay, with the closing costs and all that stuff.
Right.
Listen, it's hard to convince someone to, 6 months ago to take a 6% plus rate and tell them you're going to have to prepay that in a lower rate environment. So,
right.
And that was kind of, you alluded to that in your first part of the presentation about making that capital stack work from both a debt and equity standpoint on the right deal was a challenge to find.
Well, and a lot of people want to say almost ignored yield maintenance in the past because it was an easy thing to ignore because it was something you have to deal with later. And then also we were in a low rate environment, so yield maintenance is less punitive in a rising rate environment rather than a falling rate environment, which has an even bigger impact when it's defeasance. So a lot of this is mumbo jumbo because defeasance, yield maintenance, some of this means nothing to some of you, but that's why it's important to have an advocate like Nate on your side to actually push for yield maintenance versus defeasance, especially in a falling rate environment, and so on. So let's move on to talking about, I want to stick a little bit more on bridge loans because I think right now it's an exciting time to buy, but a lot of deals are just so tough to wrap your arms around, especially if you're talking about more like a distressed type deal, which I feel like the word of the year last year was distress, and the word of the year this year is distress, but there's still none of it. Right? So where are the bridge loan use cases really?
They're still distressed. What we're seeing a lot is that lenders are kind of, with the distressed bridge loans, unless it's like a severely distressed loan, they kind of want to wait and see, kind of kick the can down the road, wait another year, see where rates are, not really book a loss. And a lot of the bridge stuff the distressed bridge loans that they are focusing on is, call it the office loans or shopping malls, where we're not just off a little bit on value and cash flow. There's severe issues there. So they're kind of this year working their way through that, and then conventional wisdom is we'll kind of fix the other ones in 25, see what happens with rates coming down. Maybe a lot of these guys will get out, but ultimately the last year has not been friendly to those bridge loans.
Yeah, I think that's where the challenge is going to be. And just speaking frankly, there's a lot of those deals that aren't in today's market worth the debt, and so it's hard. Coming out of the GFC, I honestly would have said, as an industry, we would be way more prepared to work those assets through the system. Last time we went through this, 2008, 2009, is really was the downturn. But these assets didn't really start coming to market until 10, 11, 12, 13, and I think we're just kind of in a similar spot. I thought there would be more infrastructure to do it. There isn't, honestly, on the lender side, and there's honestly just not a desire, to Nate's point, where it's a little bit easier to take a wait and see approach.
Yeah. But the one beauty is that, and we've talked about this all the time, multifamily, the fundamentals are still there.
Right.
Right. Maybe some guys over-levered a couple deals here or there, but the fundamentals for the multifamily side are still there. Office, I don't know what the fundamentals look like right now. It's not as great as it was. So, I think lenders are hoping that with, like I said before, a cut in rates, that maybe they'll be able to get out and it's not really worth booking a loss because the fundamentals of multifamily are still there.
And this is going to create a boom at some point, whether it happens in the next 12 months, 24 months, 36 months, I think is going to be really dictated by the underlying lenders as to when this stuff makes it out through the market. But if we get that in combination with what the Fed is saying, rates down 300 or 400 basis points next year, all of a sudden, I would imagine from your side, the math starts to say, okay, I can get my arms around this, and this makes sense, and I can see a path with the economy getting better and growing at a higher rate, that there's an equation that works. And it's the firms that have that infrastructure and operational expertise that are going to be on the forefront of being able to make these deals work. And honestly, it's who the lenders are going to want to work with at the end of the day. We're not going to take the same bet on the same sponsor. It's going to be the sponsors that have the track record through the last cycle and are frankly in a position to take these types of projects on.
So you mentioned the GFC earlier. Something I find very interesting is how the lending market has shifted over time and how the growth market has actually had an impact on that. So Brad, do you want to touch on regulations and how things have changed from banks versus non-banks and things like that?
Sure. When you've been in this for over 20 years, especially on the agency side, we are constantly buying and selling ourselves and merging, and there's always consolidation. If we kind of go back GFC time, the largest agency lenders at the top every year were generally the banks. Coming out of the GFC and really kind of Dodd-Frank was the biggest change in our business. While Dodd-Frank was 2010, 2011, there's still stuff today being implemented from that original bill. And so that's changed quite a bit, the capital requirements that banks have to have, which did impact the agency side. That has changed the oversight and reporting that banks have to have from that standpoint. And so what we saw kind of through the mid-teens and early 20s was really a shift of these agency license in the volume to shops that are also investment sales. So it's been as much, similar to other industries, there's always vertical and horizontal integration, and it's been no different in our business on the agency side. I mean, I'm one of them. I work for Greystone. One of my partners, John Carr in Texas on the sales side, is sitting over there, where we're more now of a partnership on the sales side. And a lot of that, I think, and you can probably even describe this better than I can, as the market heated up and deals became more competitive, it was trying to find any angle, right, to win the right deal. I think, over the last 12 to 24 months, there's been a bit of a decoupling of that as relationships have become more important, and there hasn't been, there's been less participants in the market that have kind of allowed some of that to back off from its peak.
Yeah, and to your point,
but not for us. And my partner is sitting right there, so that doesn't apply to Cushman and Greystone.
To your point, I mean, obviously now when there's a lot of uncertainty in the market, having the right relationship with the right lenders and the right contacts in the right lenders is key to make sure that you get that last slug of deal terms needed to make a deal happen and to get it closed in time.
And it didn't really benefit buyers or sellers in a hot market where there was this consolidation between the investment sales team and the capital markets team, where if you wanted to buy a Newmark deal, you had to finance the deal with Newmark, right? The buyer didn't like that because the buyer wanted to use their debt relationships, and the seller didn't like it either because why would they want a buyer doing something brand new for the first time on their deal, right? At the end of the day, sellers care about price, terms, execution, and that was at odds. So it was, I think, a negative ramification of a hot market, and I think it's very healthy. So, yeah, I mean, Nate, you and I have battled a lot as far as pitching, not using their debt team, and trying to still win the deal and stuff. So I think that's just an interesting thing to keep an eye on, and a very powerful thing to be able to have as a more tenured sponsor, where you're bringing more to the table to the sales team as well as to the seller and saying, you know what, I don't have to play that game, but it's easier said than done.
Yeah, well, I mean, at this point, you have a track record, right?
Right.
So, like, there's no, hey, this may happen, may not, let me use my guys. Go look at my book. You know, this is how we've done it. If you want to close quickly, is the best way to do it.
Right. So let's talk about, Nate, this is your opportunity to talk about other debt strategies that you're seeing across your business outside of multifamily. What's interesting right now?
So I touched on office before. Yeah, obviously New York City is still going through a tremendous amount of vacancies. I think it's something like 90 million square feet of vacancies happening now in New York City office. One thing that's changed recently is that there seems to be more momentum going back. You know, if you came to me a year or two ago and said, what's the future of the office market? I don't know. But now it seems to be, hey, if we reset the basis on the operations and we could charge less for rents, there will be tenants that will come. So office has gone from like a nightmare to kind of, hey, you know, we'll reshuffle, we'll figure it out, and we'll get something going. So, you know, and we're seeing a lot of activity in the office space. And there is capital for it. It's not as cheap as other assets. Definitely still some risk there. But, you know, there's definitely a lot of movement going on now in the office space. Student housing, we're seeing a lot of opportunity there. You know, student housing was kind of quiet during COVID when colleges were shut down for obvious reasons. But it seems like students are back and want to get out more. So student housing is starting to pick up, and retail, surprisingly enough. Retail, which, you know, from 17 to 20 was, you know, Amazon knocked us out. People seem to now be coming back to stores, and also similar to what happened with the office market, what's happening now with the office market, a reset in basis, and now things are starting to make more sense on the investment side, on the tenant side. We're seeing a strong demand for good retail going on now.
Okay, so now we've got a couple minutes to open the floor for Q&A. I'm sure we've got some questions. Alan.
So I thank you gentlemen both very much. I think you both gave a lot of insight. So I think I don't know which one of you mentioned that you don't have crystal balls. So here's a question. Forget personalities aside. How about the Republican or Democratic administrations, and how will that impact interest rates going forward based on the next 6 to 8 months, would you think? Because they both have two different philosophies.
I think either side is going to keep spending, which is going to make the inflation piece difficult. They may spend the money in different areas, but I think the biggest threat to interest rates is probably the inflation piece. You know, I know it's on the Democratic side, it is probably a little bit more regulatory heavy. There's definitely been, I mean, we've heard Vice President Harris actually talk about tenants' bills of rights and be a little bit more focused on that part of the market. There's been, you know, side proposals for various types of rent control or things in that genre, not being, you know, as punitive as rent control. So I you know, if I were looking at the two apolitical, I think I'm not sure there's a huge difference, honestly, in rates between the two. I think there's probably a little bit more of a regulatory threat with a Democratic controlled government. That's just my personal opinion.
There's also conservatorship risk with Republicans.
That's a great point. I mean, that's where we were headed during the last cycle and I think the agencies are actually still retaining earnings from that last pass. So that's another risk of the Republican side is, you know, could we end up being public and is the capital protected?
Yeah. So what would that do to spreads, to lending criteria? Would that change Fannie and Freddie from being more affordable driven to just a market participant? Do you guys think about that at all?
I do. So the real question is how implied or explicit is the guarantee on the agency bonds? So, you know, essentially the agencies, the reason, and, you know, I appreciate everyone paying their taxes so that I can lend subsidized rates on multifamily. So, the key there, and prior to the GFC, they were public companies, and technically there was no explicit guarantee. It was always implied that the government would bail it out. Well, that happened, right? So the question is how strong is that language? Because that's really the difference between the difference between agency lending and CMBS. And so a CMBS spread is going to be 100 to 150 wider. So I think that's probably what the market is telling you how much that guarantee backed by the government is worth. So that would certainly be the risk on the Republican side.
Do you think the agency's balance sheet is strong enough that they no longer need the government's protection?
No, I don't think that's ever. The trillions of dollars that it takes to backstop would be the challenge, and it's really the single family side. I mean, when it's the multifamily side is $800-900 billion. The single family side is $4 to $5 trillion of that debt. So, which sometimes makes it a challenge when they do shift these ever-changing regulations. It's coming more from the single family side, and we're getting wrapped up in the sidecar.
Again, I know you don't have a crystal ball, but I know the 5 and the 10-year moved dramatically. Just curious, maybe even historically, and COVID was maybe an outlier, but how much is already maybe priced into the 5 and the 10-year, and where do you see that moving as rates drop?
I think too much. So even if you think about being at a short-term rate of 3% next year, and the 10-year I think is probably plus or minus 375. That's been this push and pull, and we've seen these periods probably since last December, depending on who says what on TV, and we get this, and they're going to cut, and and that's the market basically pricing in what their projection is. So it's a little bit, I think the 5-year is probably pretty close to where it should be, but I think the 7 and 10s are probably a little bit overbought based on what the Fed is actually saying. And Powell, to his credit, has pretty much stuck to what he's done, and then that's when we get those rates shoot back up because the market's expecting one thing, and Powell's like, I told you what I was going to do, so why do you not believe me type thing. So I don't know if I see the huge swings, honestly, that we saw this year, but there's probably a little bit more to the bond sell-off or rates going upside in the short term, but I think we stay below 4%.
And right now, all-in coupons are in the 4s and 5%. We've been doing business at those rates for years before COVID. That's basically where they were.
18 and 19.
Yeah.
These were the same rates.
And people were transacting. Things made sense.
Thank you.
Another question? All right. Yeah, perfect. Thank you very much.